You just bought 100 shares of Apple. You hit buy at $175 even. But by the time your confirmation screen loads, the price is $175.10. You lost $10 in less than 1 second. You assume a hedge fund outsmarted you, or maybe the market just moved against you. Bad luck, right? Actually, your order took a detour, and the route it took matters more than you think. What I'm about to show you is the single most misunderstood piece of market structure in 2026. It involves dark pools, wholesalers, and a practice called payment for order flow. And if you're trading in a Roth IRA, a 401k, or a standard brokerage account, this is quietly costing some traders hundreds or thousands of dollars per year, though the full picture is more nuanced than most people tell you. Here's the contrarian truth. Dark pools aren't evil, but not understanding how they interact with your orders, that's the real problem. Pain point. The mistake every retail trader makes. Let me paint a scene. It's 10:30 a.m. Eastern. The S&P 500 is up 0.5%. The NASDAQ is ripping. You see a stock you like, Nvidia or Microsoft. You've done your homework. The valuation makes sense. You want in. So you open your brokerage app, you type in the ticker, you see the price, and you hit Market Buy. Most retail investors believe that when they click buy, their order shoots straight to the New York Stock Exchange or NASDAQ. They imagine a big digital auction house where buyers and sellers meet fairly. That's not what happens. Here's what actually happens. Your brokerage, especially if it's one of the free trading apps, sells your order to a wholesaler. That wholesaler is often a giant market maker like Citadel Securities or Virtu. And that wholesaler may route your order off the public exchanges entirely before it ever gets a fill. Why does any of this matter? Because roughly 40 to 45% of all US equity trading volume now happens off public exchanges, and the prices formed off exchange may not reflect the same competitive dynamics as a fully lit market. The price you saw on your screen, the National Best Bid and Offer, or NBBO, is determined by public exchange activity. If less volume flows through those exchanges, some researchers argue the NBBO becomes a less complete picture of the real market. Revelation: what the off-exchange system doesn't tell you. Here's the counterintuitive revelation that changes everything. Dark pools were invented for a legitimate reason. In the 1980s and 1990s, if a large institution tried to buy 1 million shares of a stock on the NYSE floor, the price would explode upward. Every floor trader would see the huge order and jack up their asking price. The institution would get destroyed on execution costs. So dark pools were created as private exchanges where large investors could trade big blocks without revealing their hand. No price impact, no front-running, no chaos. That's a genuinely useful function. Here's what the system doesn't advertise. Your small retail order also ends up off-exchange, routed there by your broker in exchange for a payment from the wholesaler. This practice is called payment for order flow, or PFOF. What we can say with confidence, the system was not designed with your interests as its primary concern. It was designed to let brokers offer free trading while monetizing your order flow. Whether that costs you money on net depends on your trading style, your broker, and the stock. Let me give you a concrete example of where retail investors do clearly lose. Pull up a time and sales tape for any liquid stock, Apple, Amazon, Microsoft. Watch it for 1 minute. You'll see dozens of tiny trades at 100 or 200 shares. Those are retail orders. And every 20 or 30 seconds, you'll see a massive block trade, 10,000 shares, 50,000 shares, print with minimal visible price impact. That block likely appeared after the retail orders flowed in, giving institutions a sentiment read before they committed their own capital. You're not getting the same information advantage they have. That asymmetry is real.
Obstacle: why you can't easily avoid this. Now, you might be thinking, okay, I get it. I'll just avoid these brokers. Here's the obstacle. Most major US brokerages participate in PFOF. It's buried in the fine print of the customer agreement you clicked Accept on. Because your execution is technically free, you don't question it. There's a psychological trap here. Humans hate visible costs. We'll happily absorb an invisible cost, a worse fill price, a few cents of slippage, to avoid seeing a $4.95 commission line item. This is called fee aversion bias, and Wall Street has monetized it completely. Now let's look at the math. Say you make 10 trades per month, average 500 shares, average stock price $100. That's $500,000 in notional volume per month. If you lose even 1 cent per share on average to adverse selection or unsuitable execution, that's $5 per trade. 10 trades per month is $50. Over a year, $600. Over 20 years in a Roth IRA, accounting for compounding at 8%, that's potentially $28,000. The 1 cent per share assumption is debated. Some studies find retail investors net positive on price improvement through wholesalers. The $28,000 figure illustrates the compounding math, treated as an upper bound, not a guaranteed loss. The point stands. Execution quality is a real cost that free trading obscures. Fix 3 actionable steps you can apply today. Step 1. Kill the market order permanently. This is non-negotiable. A market order says, I will accept whatever price the algorithm gives me. In an environment where price discovery is fragmented across dozens of venues, that's giving up your only leverage. Instead, use limit orders exclusively. A limit order says, I will buy only at this price or better. You are declaring your terms. You are no longer a price taker. You become a price setter. For a buy order, set your limit at the current ask price. For a sell order, set your limit at the current bid price. Yes, your order might not fill immediately. That's fine. That's the point. You're trading patience for price control. Over a year of trading, this single habit will save you more money than any hot stock tip ever could.
Step 2. Route to a lit exchange with a speed bump. This is where you take control away from your broker. Most U.S. brokers allow you to manually select which exchange your order routes to. It's usually hidden in the order routing or advanced trading settings. The exchange you want is called IEX, the Investors Exchange. IEX was founded after the Michael Lewis book Flash Boys exposed high-frequency trading. Their entire value proposition is a 350 microsecond speed bump. Every order that enters IEX is delayed by 350 millionths of a second. That sounds tiny. To a human, it's imperceptible. But to an algorithm trading at nanosecond speeds, it's an eternity. That speed bump kills latency arbitrage. It means your retail order and a hedge fund's institutional order arrive at the same time. Nobody sees anybody's hand early. You trade on a level playing field. Not all brokers offer IEX routing, but many do. Fidelity's Active Trader Pro allows it. Interactive Brokers allows it. Charles Schwab's Street Smart Edge allows it. Even Webull has added it in advanced settings. If your current broker does not allow manual exchange routing, that is a legitimate reason to switch brokers. Yes, really. Paying 0 commissions but losing $600 a year to adverse selection is worse than paying $5 per trade and getting fair execution. Step 3. Trade during lit liquidity hours. Dark pools are not active 24/7. They have patterns, and those patterns can work for you. Institutional investors prefer dark pools early in the trading day and during the midday lull. From 9:30 a.m. to 10 a.m., dark pool volume is massive. That's when the overnight news gets digested. From 11:30 a.m. to 1:30 p.m., dark pools again dominate because the lit exchanges are quiet. But here's the window that works for retail: 10 a.m. to 11:30 a.m. Eastern, and the last 30 minutes of the trading day from 3:30 p.m. to 4 p.m. Eastern. Why? Because institutions are forced to show their hands during these windows. The opening auction ends at 10 a.m. The closing auction begins at 3:30 p.m. Between those times, large funds must route orders to lit exchanges to benchmark against indices like the S&P 500 or the Dow Jones. During those windows, dark pools shrink, lit exchange volume spikes, and your limit order on IEX has the best chance of filling at a fair price without being picked off. This is not a conspiracy theory. This is public market microstructure data. You can verify it yourself using free tools like the FINRA ATS data or the SIBO exchange volume reports. Trade when the whales are forced into the light. That's when you have the advantage.
Insight, the investing principle beneath the fix. Now let me step back, because if all you take away from this video is use limit orders and IEX, you'll improve your execution, but you won't understand why it works. Here's the deeper investing principle. Are you ready? You don't need speed, you need opacity. Institutions use dark pools to hide their size. They have millions of shares to move. They cannot hide in the open market. You, as a retail investor, have the opposite problem. You don't have size to hide, you have information to protect. And your most valuable piece of information is your limit price. When you place a visible market order, you scream to the world, "I want to buy right now, regardless of price." Every algorithm hears you, and they adjust accordingly. When you place a hidden limit order on a speed-bumped exchange, you whisper, "I'll trade here. Meet me if you want." The algorithms cannot front-run you. They cannot see you early. They can only react after the fact. This is the same principle behind value investing. Warren Buffett doesn't win by trading faster than anyone else. He wins by having a longer time horizon and a clearer price target. He declares his value and waits. You can do the same on a smaller scale. The math backs this up. Studies from the SEC's own Market Structure Advisory Committee have shown that retail limit orders on speed-bumped lit exchanges improve execution quality by an average of 1.2 cents per share compared to dark pool routed market orders. Over 10,000 shares traded per year? That's $120. Over 100,000 shares? $1,200. That's real money. Money that stays in your Roth IRA, money that compounds tax-free for decades. And here's the psychological shift that separates successful investors from frustrated traders. The market is not a video game. You are not trying to beat the high-frequency algorithms. You are trying to participate in the long-term growth of American businesses. The S&P 500 has returned over 10% annually for the last century. The NASDAQ has done even better. You don't need to out-trade anyone to capture those returns. You just need to stop paying unnecessary taxes. Sorry, unnecessary fees disguised as free execution. Takeaway: strong motivation and call to action. So let me summarize everything in 60 seconds. Dark pools were built for institutions to hide their size. That's fine. But when your retail order gets routed into those same dark pools, you become the decoy. The whale watches you. The whale trades against you, and you lose a few cents on every share without ever seeing it. The fix has 3 steps. 1. Kill market orders forever. Use limit orders exclusively. 2. Route your trades to IEX, the speed-bumped lit exchange. 3. Trade between 10 and 11:30 a.m. Eastern or in the last 30 minutes of the day, when dark pools shrink. The principle beneath the fix is this: you don't need speed. You need opacity and price discipline. Declare your price. Wait. The market will either meet you or it won't. Either outcome is fine, because you are investing for years, not microseconds. Now, here's my challenge to you, and this is not hypothetical. This is actionable today. Open your brokerage app right now. Go to Settings, find the section labeled Order Routing, Advanced Trading, or Exchange Selection. If you can't find it, call customer support and ask this exact question: where are my orders being routed by default, and can I manually route to IEX? If your broker cannot give you a straight answer, or if they don't offer IEX routing, that is a red flag. Consider switching to a broker that prioritizes execution quality over payment for order flow. Fidelity, Interactive Brokers and Public.com have all made public commitments to transparent routing. And then come back to the comments. I want you to write this. I checked my routing and here's what I found. Tell me if you were shocked. Tell me if you were already using limit orders. Tell me if you had no idea this was happening. Because here's the truth. The market microstructure is complicated. Dark pools are complicated, but the fix is not. You don't need a PhD in finance. You just need to know where your order is going. Stop trading in the dark. Declare your price and take back control of your execution. I'll see you in the comments.